Alright, let's finish up this set of problems with a final video. Number 12, which we didn't cover in class for the exam review, is about a company. They're going to purchase a machine. The machine has annual cash flows for 5 years. Right at that point, you should think this is something coming from chapter 14. It says at the end of the 5 years, no salvage value, the company's cost of capital is 12%. What is the internal rate of return? All right, an important point to make here is when the question asks for internal rate of return, you are looking for an interest rate. All right, so don't be fooled by this. The company's cost of capital is 12%. That is somewhat of an irrelevant bit of information, although we'll talk about that in just a second after getting the correct answer. All right, so mapping out the cash flows, here's what we know. If you put $57,000 in now, then for 5 years you'll get these cash inflows of $17,411. Obviously an odd number, but we'll explain why you get that odd number in just a second. Alright, so the present value of this annuity is the $57,000, and that's going to be equal to a factor where n equals 5 and I is unknown. Right, we're solving for that I, multiplied by 17,411. Right, so divide both sides of this equation by 17,411, and what you wind up with is this factor of 3.273, where n equals 5 and I is unknown. All right, so this is an algorithm. And like we did on the prior problem, if you're using tables, first of all, go to the annuity table because this is a steady stream of payments. N equals 5, and our algorithm is we're searching across looking for this number, 3.273. We almost find it exactly, which is odd, and if you think about it, this problem was reverse engineered. That's why the odd amount here, 17,411, just made it easier so you would land exactly on a number. Once you find that number, look up. That is your internal rate of return, 16%, which is answer D. All right, so the only importance of cost of capital in a problem like this is to decide whether this is a good or bad investment. Right? So if it costs your company 12% to get money and you're looking at a project that will earn you 16%, then that's a good thing. Right? You should do that project. Had this internal rate of return been anything less than 12%, that would be a bad thing. So again, don't be fooled by cost of capital given to you when a problem asks for internal rate of return. Right. Keep in mind when internal rate of return is a question, you are looking for an interest rate. Now let's move on to the next question. This is a word problem, and honestly not the best word problem. It says direct materials needed for production is calculated by, and you have a series of statements. The correct answer is A. It helps to put some kind of context here. You'll get material needed for production by multiplying the units needed to be produced. An example might be cars by the direct material per unit, and here an example might be headlights per car. Right? So if you're trying to budget how many headlights you need to produce, if they're part of a bigger product, A is correct. All the others are incorrect for various reasons. Again, not the world's best problem. All right, let's look at 16, which is a budgeting problem, very similar to prior problems we've gone over. You get a series of information. It's kind of a long problem. It's often helpful to skip down to the end and get in mind, what is this problem asking me to do? This one is asking you for how many units this company needs to produce in February. All right, and so using kind of the template model that we've gone over in class. Anything that you're producing, accountants generically call that inventory, so we get information about January, February, and March. This problem is all stated in units. Right? Inventory works where you have a beginning balance and ending balance. Something goes in, something comes out. In this case, what will go in is new production, right? New products in a box. What will come out is sales. You have information about sales in January, February, and March. And then we have that rule of thumb, right? So the rule of thumb in this case, if you look up here at the problem, Connor wants to have 35% of the following month's sales in ending inventory, right? So we need March's projected sales, and we need to multiply that by 35%, sorry, to back into what February's ending inventory needs to be. Likewise, we look at February's planned sales, multiply that by 35%. That lets you back into what January's ending inventory needs to be. And again, ending inventory in 1 month needs to be the beginning inventory in the following month, right? So you close the doors on January 31st. And when you open the doors on February 1st, that inventory still should be there. Right, the goal is to solve for this boxed number, the production, which we get D 35,950. So if you started with this many units, what do you need to add so that you can sell 37,000 and still have 11,900 remaining? Given the number of problems like this you've seen, definitely expect some of those on the exam. All right, and then finally we have a problem similar in nature, except here we're going to talk about cash. All right, so a company has a sales forecast, a lot of information. It's helpful to go down to the question. It says, what is the cash balance at the end of January, assuming that cash is received only from customers and that 48,000 is paid out during January. All right, so the key is, what is the cash balance at the end of January? All right, here, important thing to note, cash and inventory are both assets, so they work the same way, right? T account entries help. Keep in mind, T account is just like an algebra problem, but these are assets, so they have beginning balances, ending balances. The problem's actually asking you to solve for this ending balance, but you're loading in information that you know about cash, right? You know how much cash the company started with at the beginning of the month. This January 1st balance, they had $22,000, which we see here. All right, they're going to add some cash, which we'll talk about in a second, and then they give you this number, this 48,000, right here at the end. Right, 48,000 is paid out during January, so that's cash leaving. Again, what we're interested in is ending cash. So the two things to consider are right here. How do you collect additional cash in January? And you need to read to figure out the cash collected in January. Right, so we get this statement that 75% of sales are collected in the month. All right, so of January sales of 36,000, you're going to collect 75% in January. So this 27,000 is cash collected in January based on these sales. All right, that's this number. All right, the only other place that you collect cash comes from the second part of this sentence. Remaining cash is collected in the following month. All right, so the accounts receivable balance on January 1st had to relate to sales that were made the prior month in December. All right, so January 1st you had $22,800 worth of IOUs, and the problem tells us that will be collected in January. All right, so that is the final number here. And so now we have this algebra problem. If you started with 22,000 in cash, added 22,800, added another 27,000, then paid out 48,000, how much would you have left? Right, that's the ending balance of cash for answer B. All right, that is now coverage of all problems.